Here's how to know whether or not your home loan is a ripoff. I don't want this to be clickbait. I want it to be real sound information. And I know there's a lot of folks I speak to on a daily basis who are comparing, they're shopping, and they want to make sure that the home loan they get is the best possible one. Especially right now, rates are a little bit higher than we would like, although I do believe we got spoiled with low interest rates, artificially low interest rates a year ago or more. But now in what I think are relatively normal interest rates, although, I mean, gosh, my parents paid, 13, 14, 15% interest in the 70s or 80s. But I think now, roughly speaking, if interest rates are in the 5, 6, and 7s, those are relatively normal rates. Although prices are higher now, they will start to come down in certain areas. But I digress. Here's how to know whether or not your loan that you're currently getting from your lender is a quote unquote ripoff, or if it's a bad deal. Number one, the most important thing, look at your loan estimate. Folks, this is a loan estimate right here. This is an example of a loan estimate, right? And in some people call it a federal loan estimate, but this is a standard document across all mortgage lenders. If you fill out an application with a mortgage lender, they are required to give this to you within 3 days. It's required by law. In the loan estimate, it has these boxes. So we call them like box A, box B, box C, box D. The first thing you want to do when you look at your loan estimate is look at box A. Okay? Usually that's on page 2. So page 2 of your loan estimate in box A, those are going to be called your loan costs or your origination charges. So you're going to have things like any points that are being charged. You're going to have application fees, underwriting fees, and any other origination charges or fees that are being charged to you, the borrower. Very important to go over those fees and see whether or not you're being overcharged, whether those fees that are being charged are justified or not, and whether you accept those fees as they are. Now, sometimes those fees are necessary depending on the structure of the loan, the type of the loan. There's a whole host of things you can talk about there, but it's very important to go over those fees in box A, okay? Or just in general, just go over your loan estimate. I can't tell you how many times somebody just doesn't even look at their loan estimate. So that's important. Box C, and yes, I'm skipping over box B because box B are services you cannot shop for, okay? I'll put a link in the description box below to what I'm looking at right now so you guys can see this. It's at the CFPB website. It's an example of a loan estimate, okay? Box C are services that you can shop for in your loan estimate. So in box C, you have different things such as title searches, pest inspection fees, and so forth and so on. Those things can, since you can shop for them, you as the borrower, those things can change. So you want to make sure to look for those, right? Watch out for those. Keep in mind that those things can adjust through your loan process, but that's an important piece because you're looking at every fee that you have to come to the closing table with potentially, okay? The next one, before we get to number 2, but this is still under 1, item number 1, look at your loan estimate. This next one, we're going to look at not just box E, but we're going to look at box D plus E minus any lender credits. Now you'll see if you look at the loan estimate, it's going to say your total loan costs, okay? And then you're going to take E, which is your taxes and other government taxes and so forth. Then you're going to subtract any lender credits, and that's actually in J. So down below in J, the reason we subtract lender credits is because if a lender is giving you a credit, of course, that's coming off of your loan costs, okay? Super important. And then you have F plus G, which are your prepaid items. Prepaid items, one big one is, of course, your homeowner's insurance. How much is the homeowner's insurance going to be? And do you potentially, if you're purchasing a home, do you want to switch insurance companies to get a less expensive fee? Okay. So number 1, big piece to know that your loan is or is not a ripoff is to look at your loan estimate, go over it in detail to make sure you understand what's in there. This is what keeps all of us loan officers honest. Okay. Number two is to get a second opinion. Have somebody else look at it, another person that you potentially trust, so they can look at these things and explain them and help you understand what are the charges, what are the fees, and potentially, is it possible that this other person could get you a better deal? One example of that I know very well about is when you have two different lenders of two different types that may be competing with each other. One person, let's say a broker, might have the ability to get you a better deal because they can go and shop your loan with 100 and whatever different lenders, whereas another lender may just be one organization, and they only offer you whatever few products they have, and that's all. Doesn't necessarily mean that that's bad, but it's good to have options. So you may compare, okay, this bank or lender over here has made me this offer. They've sent me this loan estimate. Let me have this broker take a look and see what they can do. It's always great to compare and contrast. We do this, of course, with lots of stuff in life, right? If you're shopping for a car loan or different things like that, super important to get a second opinion. And then the last thing are what are called loan level pricing adjustments. A lot of you out there maybe don't know what this is. These can affect the cost of your loan. So this is just a piece here that I want to give to you guys. So the next time you shop for a home loan of any kind, you'll know the things that affect the cost of your loan. Before I talk about these, though, these what are called LLPAs, or loan level pricing adjustments. Okay. Let's talk first about risk. When you are shopping for a home loan, you are going to a person or usually an organization of some kind, a group of people who are lending money. Those folks are willing to lend money based upon a lot of different factors. And generally speaking, risk and reward are correlated. So how does that generally kind of overshadow what we're talking about here with these pricing adjustments? What it means is that generally speaking, in home loans, when there's a higher risk, there's going to be a higher cost for that risk. When there's a lower risk, generally, there's a lower cost. So what do I mean by that? One of the loan level pricing adjustments is your credit score. If your credit score is pretty low, that doesn't necessarily mean you can't get a loan. It just means that right now, today, your interest rate could be higher, or the cost of doing the loan could be higher, or other factors may be higher or not as desirable as they would be if your credit score was a lot higher. Now, let's say, for example, that you have a low credit score and you're still able to get a loan, because I do this every single day with my clients. You could potentially do that loan, and then maybe in 6 months to a year, you can refinance, possibly, depending on your situation. But the first thing, of course, with the loan level pricing adjustment that we look at is credit score. That affects the price and the cost of your loan, what a lender is willing to give you in terms of rates and pricing and so forth. The second thing is your loan to value. The greater your loan to value, in other words, how much the lender is coming to the table with, right, to, let's say, to purchase the home versus yourself, that will affect, right, how much pricing or the types of pricing you could get on the loan. For example, let's say you have a $100,000 house, or let's say it's $200,000 or something. If the lender is bringing 95% of the funding for that loan and you're bringing 5%, your pricing potentially is going to be different than if you're bringing 25% down on that loan and the lender is only bringing 75%, right? The lender may say, hey, we have less skin in the game. So that means that your pricing is better because you're coming with more down, right? That will affect your pricing. Also, another third thing that affects the pricing, your loan level pricing adjustments, is your debt to income ratio. Lenders definitely care a lot about your debt to income ratio. Now, for those of you who don't know, what's a debt to income ratio? Generally speaking, the debt to income ratio is just a ratio of how much income you are bringing in over how much you're paying out monthly on your debts. Just an easy way of thinking about it, right? It could be something like, let's say you have a debt to income ratio of 50%. That means that 50% of your income is going to pay your debts each month, right? Now, the higher your debt to income ratio, the more of a strain a lot of lenders will see in your financial situation, such that it doesn't necessarily prohibit you or stop you from getting a loan. It just means that, again, the cost of the loan might be higher because the lender is saying, I think this is a little bit more risk, right? Versus, let's say your debt to income ratio is very, very low, meaning, let's say only 10% of your income is going to pay your debts and your bills and so forth and so on. And the rest of it is like savings and extra income. Well, now the lender with that situation may say, wow, okay, we're willing to lend a lot more, or the cost of pricing is less. Okay. So those are just a few examples. Two more examples of loan level pricing adjustments is going to be the type of loan. Different types of loans come with different types of risk, right? A 10-year loan would be potentially different in terms of risk for many lenders than a 30-year loan. An ARM loan or an adjustable rate loan, adjustable rate mortgage, is going to be different in terms of risk and pricing than a 30-year loan. So that will affect it. So you've asked the question, what kind of loan am I getting, right? Not only am I getting, a 30-year, 15-year, 10-year, but also, is it an FHA loan? Is it a VA loan? Is it an investor loan, a DSCR loan? What kind of loan is it? Very important to ask those questions because the higher the risk, generally the higher the cost, right? That will affect it. Now, of course, if you can see that the lender is taking very little risk, but yet the cost is very high, you probably want to get a second opinion, right? I would say get a second opinion anyways, but it's a good idea to get a second opinion because maybe you're being overcharged for that loan. Okay. The last thing is your house type or the type of structure, right? The type of home. These loan level pricing adjustments can be affected very much by the type of structure that's being lent on. As an example, let's say the house is a manufactured home. Well, many lenders would consider a manufactured home to be a slightly higher risk loan than, let's say, a fixed structure or a stick build, right? That's been built on site. That's going to affect it as well. This also has to do with commercial and things like that. Won't go into commercial very much, but in general, the type of property that the lender is going to lend on will also affect the price. The last thing I want to say here too is that these loan level pricing adjustments, all these things we mentioned here, they can affect the pricing by different degrees. Okay, so you want to have the right person explain that to you and discuss with you how each of your specific things in your profile, in your financial profile, in your loan application, right? How those affect the pricing. So my name is Aaron with Logical Loan. My hope here with this channel is to provide you guys, potential home buyers, investors with good, sound, no nonsense information about all things real estate, mortgage, real estate investing, and so forth and so on. Lots of good information in the description box below. Thanks for watching, and we'll see you on the next one.